G'day again. Welcome to this weekend update for February 6th. And we've got this rally in the US market continuing, as you may have caught up with on Friday night into Saturday morning. So it looks like we're going to have another fairly bright start on Monday. But importantly, the Australian market did break higher on Friday at an index level, and certainly at some of the major stock level, BHP in particular. And that technically is likely to bring in a lot of buyers who've been reluctant to buy into the Australian market. So I think we could see quite a good move in the early part of next week. Some other key charts that I want to take a look at. So we'll get stuck into those right away. And there's the important information on the fact that this is general information only. So let's have a look at a general summary of where the market is at. The S&P 500 index, the surge is still very much intact, and whilst there might be some intermediate target levels, for me I can't see a great deal between here and 1400, which is another 100 points, or that's nearly another 1,000 points on the Dow Jones. So that's very, very strong and could push our market up above the 5,000 mark. We'll take a look at the Aussie indexes, the main index, the sectors, and also the important XSO for us as well. And that XSO is still looking very powerful, and we could see a break into new highs on that on Monday as well, and if not Monday, then probably Tuesday. I want to have a look at the US dollar and 30-year bonds in particular, because that's the 30-year interest rate is something we've got to watch fairly closely. So we'll take a look at that. The US dollar was temporarily higher on Friday night. I think that's probably a bit more about just the relative value to the euro more than anything else. And finally, commodities, base metals were still rising. They were higher again on Friday night. Precious metals were down a little bit, and I'm still thinking that we may not have quite seen the bottom in gold and silver, but I don't think it's very far away. Oil's heading higher. To me, it looks like oil's going to head above $100 a barrel later on this year. And, of course, the tin price is still exploding as well. So we'll take a look at a chart of the tin price. And, in fact, there it is right now before we go on any further. So you can see here, this is a 2-year tin price from February of 2009 through to the current time, and you can see back in February of 2009 it was trading around about $10,000 to $11,000 a tonne, and since then it has moved up very strongly and is pushing on closely towards $31,000 a tonne. So it's basically tripled in the space of 2 years, and the impact on profitability of tin producers is quite dramatic when the price of a commodity triples in value, because their costs are not tripling in degree either. So that allows a huge ramp up in profits. It obviously will bring new exploration out, which will over time tend to cause a catch-up. But my reading or the catch-up between supply and demand. But my reading is that just the time it takes to explore and develop a mine and bring it into production, that we're going to have this shortfall for probably the next 4 to 5 years. So I think the outlook for tin producers looks extremely strong. So let's have a look at some of the charts now. So first of all, we'll have a look at gold and silver. So gold, just pan back here, and you can see we've got this very strong uptrend, which really got into gear back in October of 2008, down at $700. We've now doubled that, and this trend line here is certainly providing excellent support. Doesn't mean that the price has to come all the way back down to that point, because you can see just here in March of last year, the price did retrace but didn't get back to the trend line itself. But it would be great to see it back there. We've got some other reference levels. We've got 1283 and 1292, these two retracement levels of varying degrees. So they're all coinciding around about this 1285 to 1290 area. So if gold were to drop down to that level, I think it would be a very strong buy at that point. But it could be that the gold stocks are already on their way, and we're certainly seeing some evidence of that in some of the majors. In fact, while I'm on that subject, let's just have a look at Newmont, which is one of the major gold producers in the world. You can see we had a bit of a breakout on Thursday above the short-term high. We then got a bit of a pullback, plus we gapped higher on Friday. We then got a bit of a pullback as well. So that's another reason why I'm not convinced yet that gold has quite bottomed. Silver, similar story. We pan back and have a bigger look at silver. You can see it's an even more powerful rally than gold. It's gone from 18 to 30, basically just since August of last year. So much steeper incline. Looking for silver to pull back to perhaps around this $26 mark. That's currently sitting at 29. That would be a pretty attractive point for silver. Next, the US dollar. You can see long-term decline, decline in the medium term. Just in the short term, we've got a little bit of a spike happening, which is not unusual, but I wouldn't expect, unless it closes above this 78.3 area, that we would actually see the dollar against a basket of currency start to resume again fairly quickly. Now, the chart that I really want to show you is this chart of 30-year interest rates. This is the 10-year Treasury bond price. So you can see the bonds peaked out here in October, and have basically been in decline ever since. We've had a consolidation period without too much of a bounce, and now it's heading back down again. So this is obviously pushing interest rates up. The more the price of bonds fall, the more that interest rates rise. And so let's have a look at the impact of that on the 30-year interest rate. So this is the area that I believe is the danger level here. You can see that we've this is back here in it's not giving me a date, but this is back here in the middle of 2007. Since then, we've fallen 1, 2, 3, 4, 5, 6. We've had 6 attempts at this $4.9% area, and I think if the 30-year interest rate spikes up above the 4.9% and stays there, then I think you could see some fairly dramatic shifts in financial markets all around the place, equities, currencies, and bond markets. So this is the danger level. The US government desperate to hold interest rates down, but they're going up anyway. So that will be a key one to keep an eye on. So 4.9%, and we spiked up again on Friday night to 4.72. So it's not very far away. That's why it's hard to envisage how Bernanke can't be looking at these same charts. And this rise started back here but basically around about the time, I'm not actually getting a date here, but around about the time that he made his speech about buying bonds. And ever since then, bond prices have fallen and interest rates have gone up, which is exactly the opposite of what he's trying to achieve. But these guys are slow learners. Okay, so let's take a look at the S&P 500. The Australian market first. So the Australian market, we've got a peak up here that'll provide some resistance at about 5,000. You can see we started to form this upsloping channel in July of 2010, and we've held that channel fairly well. And we were sitting around about the middle of the channel on Thursday, but we've now moved up and heading higher. But as you can see, we could go to 5,000 without breaking the top of the channel. In fact, we could move to 5,000 quite quickly and not break the channel. So that's why I think now that we've made this technical breakout, Let's just see.